Welcome back to What's on Your Mind. We're in a new year and a fantastic new year to all of you watching. Great new year to Jason and Raj who are joining me today. Now, if you guys who are watching have forgotten what this show is all about because of this kind of festive frivolities you've been taking part in the last few weeks, then it's basically about giving you guys access to professional level traders, thinking about how they generate trade ideas, how they come up with good ideas that they can implement in their own portfolios going forward. And that is exactly why we've got Jason and Raj here on the call today. Guys, fantastic to have you on the show again. Like I said, hope you had a good break as well. Let's get straight into things. And Raj, we'll start with you. What have you been looking at?
Happy New Year, everybody. Nice to see you all. I've been looking at a lot of things here. And what's amazing to me is all the data that I see. A lot of what I'm reading was my New Year's resolution to read more. And then when I realized I read more, then I realized I'm just reading all the same stuff again, if you read the financial data. But what's specifically what I'm talking about is when I've never seen going to 2023 a market where the hedge funds, strategists, everybody, it seems, has the same narrative. The same narrative is, I could spare you hours of reading it. The narrative from almost all these guys is the same thing. The recession risks are mispriced, and the risk and in the equity market is priced for a soft landing, and the market's ignoring the real recession risks. That's what everyone's saying. It's amazing. They're saying the valuation at 17 times earnings in the S&P is just too high. It's like literally they've all read the same book report and they've just printed it all out, the same thing. And the same thing in terms of what names specifically, growth names are underloved. You need to be in value, and while there's some truth to all that, you can't just broadly say that, but, to say the same thing by value. Well, what is value? Where is the value? What growth should you not sell? What growth should you sell, I should say? Because I really think that when I go through one of the names specific, go through later, that there is growth in some value names, and there's growth in growth, and there's no value in some value names. So, you can't just with a broad stroke and broad brush and say, this is what you need to do. And I just don't really, and I think there's a chance that I think this whole narrative might be wrong, which I'm going to go through a few specific data points. In terms of when they're saying it, if it's almost like if you look at their year-end 2023 estimates for most investment banks analysts, it's all the same. They're within 5 to 10% up or down from here, and mostly around 0 to down 5% is the end of year S&P target. And I think, they're also saying that it's going to be a weak first half, and then the back half of the year will be better once rates subside and the recession happens, and no matter how deep or soft it's going to be. And I think some of that is actually it might actually be flipped a little bit in my mind broadly. I mean, I think a few data points that are constructive to the market in the short term is I think the VIX settling around 20 is constructive. I also think that CPI is peaked, which is not really saying that's also sort of consensus. But I wouldn't be shocked to see the outcomes flipped, like I said, because of a lower CPI and hence the pause in rates, and with wage inflation stagnating. So if inflation should come down here in the first half of the year, there will be pressure on the second half earnings, not because of recession, just because of earnings will stay flat and they won't have the inflationary pressures to make earnings go higher. So, you can also see that in terms of fund flows, which I follow. I don't want to bore you with the full flow show, but the bottom line is you're seeing big outflows of equities from hedge funds in early January. And even though we've seen huge outflows, the market's held up pretty well. So could that be bullish short term? I don't base my fundamental decisions on those type of factors, but it could be that would it shock me to see a rally here in January and February when all the hedge funds are out and everybody is going to get pissed off, and then they're going to see after 2 shitty years, to be honest, well, really more 2022, and hedge funds are already trailing the broader market, and then they start getting desperate. Sure, I mean that sets up for a they always as you want to start out strong, and maybe they're not going to start out. If hedge funds don't start out strong, it could be another bad year for hedge funds. And the other thing is too is when you look at analysts, like other than Tom Lee, Fundstrat, not him, not the one that was married to Pamela Anderson in Motley Crue, but other than him, I don't see anyone talking about new highs in the first half of 2023 or at all. So bottom line is, having said all that, I think what I'm focusing on here is, and I think you should as well, remember, there's always a bull market and a bear market in certain parts of the economy and certain stocks, and that's where I'm focused. Remember, this is a market of stocks. This is not a stock market. So specifically in terms of names, which I'm going to go through one idea later, there are still shorts that I like. I don't want you to think that I'm fully bullish here, but there's shorts that I fundamentally like. And in terms of new fundamental shorts, they're getting close, but I'm not quite there yet on a couple. I continue to like the ones I've talked about in the past, specifically in the crypto, the auto space, and consumer space. Consumer space is interesting because no matter what, if we're in a bull market or a bear market, there's always longs and shorts in that market, given the nature of changing consumer tastes, consumer wants, no matter what the macro data says. So I do have some shorts, but I do want to turn it over to Jason here, and I'd love to hear his opinion from the other side of the pond.
I think that's a really interesting little piece you've just made there, Raj. Lots of good points, because so I did a presentation back at the beginning of December precisely about is the risk of a deeper recession fully priced in. Now, that was at the beginning of December, and since then, obviously, we saw the market fall further. We saw no Santa Claus rally. A lot of people were kind of looking for that. It never happened. In fact, it was a real damp squib, and obviously the market was fairly weak. So coming into this year, we have time to kind of reflect over the holidays about how we're going to approach Q1. I started thinking, well, even though fundamentally I still think what I said in early December is correct, it is literally, as Raj has just described, everybody is now saying the same thing. And it's not that you want to be contrarian for the sake of it, but we often think in terms of where is the pain trade. And I think it's pretty damn clear that the pain trade in Q1 is a strong market. And I'm quite frankly now, I think the kind of shock factor of Powell saying something bearish that's going to spook the market, or the incessant focus on the CPI reading, which of course we've got one coming up soon again. I think, like when you've been smacked around in a boxing ring, after a while you get a bit numb to it. And I mean, obviously I wasn't a very good fighter, but you do get numb to it. And I really do agree with Raj about this. And I've changed my portfolio composition coming into the start of this year as a result of that. So as Raj points out, we're always long and short, but I've taken profits on large chunks of my short positions, which have been in things like Apple and some of the listed private equity companies and some other things, because they've gone really right. And I've ended up going from a small net short exposure to a small net long exposure. So like Raj, I'm not like rampantly bullish. And I think there are fundamental reasons why that would be, slightly foolhardy. However, the point is that when everyone is saying the same thing, no matter how much sense it makes, it also tells you something about positioning. And that's why the pain trade is definitely, I think, up. And so I've got 3 long ideas that I've put on in the last week and a bit, which I'm going to talk about. And they're not the only longs that I've put on. I'm not just long. I'm long and short, but I'm now running a net long exposure because of what Raj and I have just been discussing. So on to the first idea, which is a stock whose ticker is CEG. Constellation Energy, market cap $27.5 billion. So it's a large-ish cap. Closed yesterday at $83.08. What do? Constellation Energy is basically, it's a clean energy company. More specifically, they are a nuclear energy company that was spun off from Exelon early last year. Now, I've spoken about uranium and the nuclear sort of, and the long-term kind of tailwinds, as I see them, to the nuclear industry and to the uranium price, which I spoke about early last year. This is not exactly the same play, but it's back on that kind of nuclear theme. So these guys produce about 10% of all of the clean and renewable energy in the US. They're the largest producer of carbon-free energy in the US. They help power more than 20 million homes and businesses, supplying clean energy and sustainable solutions to homes, businesses, the public sector, and a range of wholesale customers such as municipalities and cooperatives. They've got 5 reportable segments spread between 2 primary business units. So the reportable segments are the Mid-Atlantic, the Midwest, New York, something they call ERCOT, ERCOT, and other power regions. The primary business units are Constellation New Energy and Exelon Generation Company. And they're mainly in 48 states across the US, but also they've got some facilities in Canada and the UK. So on the quants, we got EPS for last year, which is yet to be reported for the full year. We're waiting for the Q4 report, but obviously with 3 quarters in, barring some kind of massive surprise, we're pretty sure that EPS for last year will be around $2.31. Consensus for this year in terms of EPS is $4.59. So that's clearly almost a 100% growth rate in earnings predicted for this year. And then for next year, for 2024, we're looking at $5.83 of EPS, which would be again a growth rate of 27%. But obviously, we're really focusing on 2023 at the moment. In terms of the P ratio, it's on 18 times this year's earnings, 14 times next year's. Dividend yield's pretty paltry. They're basically in investment mode, so the dividend yield's like 0.7%. Short interest, basically negligible, 1.5% and 2.5 days to cover. The earnings growth for the sector is basically, for the competition, is fairly anemic. It's around 2.5% for this year, 4.5% for next year. So these guys are clearly in a sweet spot. And, as you would expect, CEG is trading at a big PE premium. So if you remember, the PE for this year is 18 times. For the sector, it's 10 times. For these guys, it's 14 times for next year. And for the sector, it's 9.3 times for next year. So what's behind the idea? As I say, these guys are all about nuclear, really. Constellation and the wider nuclear energy industry are gaining traction in many countries, but also, of course, in the US. And essentially, nuclear, is going to be playing a much more significant role if anybody has any chance of getting near their emissions goals, which I doubt they will. But nuclear is one of the best ways they can do it. Number 2, they are going to benefit from the energy focus aspects of the Inflation Reduction Act, the IRA. So according to the CEO, the IRA basically puts nuclear on a level playing field with the other clean energy sources. It means that the company can invest in upgrading their existing plants, many of which are, decades old, and also to keep them running and make further improvements. So the IRA, according to the CEO, basically provides a price floor for nuclear power, which is obviously very helpful. Number 3, they're improving the current stock to try and get more longevity out of them. They're also preparing for the future with these things called small modular reactors, SMRs. So they've teamed up with Rolls-Royce of the UK to make and design these SMRs, which eventually they could be installing these on existing sites as well as places such as retired coal stations, which would give them obviously even more growth. And essentially, the tax incentives and the funding efforts that are part of the Inflation Reduction Act is going to help them add more reactors to their already existing base of over 20 reactors. Now, as I said, to be clear, this is basically a nuclear power generation business, but they also got some exposure to hydroelectric, wind, and solar. And despite all of the headlines that we hear about solar and wind in particular, nuclear is still the largest US source of clean energy. And interestingly, nuclear's share of overall US electricity generation has basically been stagnant at 20% of total electricity supply since 1990. And I think that it's got a real chance of becoming now, the dominant alternative energy supply. So earnings reports, as I say, they haven't reported Q4 yet. The last report was Q3 at the beginning of November. Bit of a mixed bag, actually. Big miss on the EPS front. So they actually made a loss, whereas they were expected to make a profit in the quarter. But a massive beat on the revenue. So they came in with 6 billion of revenues versus expected 3.9 billion. They maintained their full year adjusted EBITDA guidance for 2022. So what was behind the loss? Basically kind of twofold. So they got squeezed at both ends effectively. So they had a continued decrease in capacity revenue, along with increased labor, contracting, and material costs, which of course is nothing that we haven't heard of in 2022. As a result, the stock price basically has done nothing since that report. It's down about 10%. I think that we really need to look forward, and I think that we need to be looking forward to the kind of medium term protection and incentives that the Inflation Reduction Act is going to bring. Next earnings will be around mid-Feb. I'm light on catalysts. When I say I'm light, I don't have any potential catalysts apart from focusing on the earnings report. The options market didn't offer me anything particularly attractive at all. Having looked at a few basic structures like verticals and calendars. Part of the reason is that there's nothing between February and May. So obviously, January expiry is basically next week. So the choice was either February or May, and it just didn't really offer me much. So I'm long the stock at these levels with a target price over 3 months of $100.
Cool, really interesting. Yeah, I think nuclear energy obviously gets a bad rap for obvious reasons, but I agree that it's the only way that countries are going to kind of meet their climate goals and things like that. So it's definitely got some tailwinds on that side. Raj, let's go over to you now. You said you had one idea that you wanted to talk about earlier.
Yeah, before we get into that, it's interesting. Jason talked about how nuclear energy is up 20% and as a clean energy, but if you ask the majority of people that don't know that, they don't associate nuclear energy as clean. They think of Fukushima and Chernobyl and all these other ones where it's not. It was an accident, but it is a clean source of energy. But it just very, very misunderstood to the layman, and So, and I think that once people, your point is valid. Once people start realizing that that they're wrong, or they're more educated about that, there's certainly tailwinds to that. And
yeah, I mean, I don't think that we'll get anywhere near these emissions targets. But if you're going to have a go at it, the obvious way to do it is nuclear.
Exactly. So yeah, I totally agree with that, and I do agree with your point about pain trades. So in terms of my idea here. The name that I'm covering today is probably the most boring name that I've ever discussed on What's on Your Mind. Certainly the opposite of something like World Wrestling Entertainment, which I talked about a few months ago, and that's a different type of pain trade, as you know. But this is a name where I don't expect boring returns. And similar to what I talked about nuclear energy, it's a market that might be misunderstood. And I think that while something's misunderstood, once people start to understand it, there's tremendous tailwinds. So the name that I want to talk about today is Jackson Financial, or Jackson National. The ticker is JXN. I'm actually getting pretty constructive on financials as a whole in both the U.S. and, believe it or not, Europe. Europe's actually had a pretty good run at financials, and I think people are starting in that sector once people realize this is probably a decent market or environment for financials going forward. But I'm still looking for value in this sector right now. I'm not ready to make a broad call on financials, and I believe there's tremendous value and undervalue right now in this stock in JXN. So to summarize what their business is, they're the leading seller of retail annuities in the U.S. Again, people think of retail annuities as boring. Think of annuities as high fees, and there's no. It's just a way for financial companies to make money. But I actually disagree with that in this market right here. But in terms of the business mix itself, the retail annuities, that's 80%, 87% of their business, of their earnings. Annuities are basically retirement savings products. There's fixed annuities, immediate annuities, index-linked annuities. You can read up online if you don't know what they are, and we can spend 5 hours talking about them offline about that. The rest of their businesses, they have institutional products, which is like guaranteed investment contracts and funding agreements. That's about 5% of their revenue, and then some insurance and other insurance, life insurance, and that's about 8% of their business. But again, the main business is annuities. If you look at as we're talking about this, the stock closed at 36 yesterday with around a $3 billion market cap, which is obviously in the sweet spot of what ideas we look at. Their PE is 1.8, yes, sub 2. And what I think is, and it's got a massive 6.5% dividend yield. So think about that, 6.5% dividend yield and a sub 2 PE. Well, I mean, that's those things don't line up, in my opinion. If you look at their last 6-month return, it's up 43%, and that's in a boring sector with a sub 2 PE up 43%. Think about that, where it's been, and it's still only a sub 2 PE. Versus the S&P's been flat the last 6 months, and even financials up 11, just around the XLF's about 10%. So that's been a massive outperformance, but I think there's a lot more to go here there. So let's look at their last quarter earnings. Last quarter, they reported on November 9th. They were estimated to report $2.75 a share. They reported $4.24. So again, a massive beat. They reported $4 billion of revenues, massively beating expectations again. And again, think about that. It's got a $3 billion market cap. They reported $4 billion of revenues. The revenue year over year grew 170% from Q3 21 to Q3 22. And they're expecting to make over $5 a share in their next quarter earnings, which is in, I believe, February, estimated around February 22nd. So on a very high level, their business, I mean, I think this company is going to thrive even further in 2023 and beyond, mostly because of the growth of that annuity market. The company is trading at obviously a very low valuation, and I think this stock could easily rally 40 to 50% plus in the next 6 months. And, they could easily do it it could be more, or it could be even faster than that. I mean, if you look at their earnings, they're expected to grow at high teens in 2023, which is ridiculous for a company of this PE and that pays that dividend yield. And more importantly, the annuity market is expected to grow at what I'm reading at like somewhere at 5 to 6% as a whole, and that's obviously a very strong catalyst just for this stock. And they're also doing a buyback, which is another tailwind to the stock, and I think that should lead to another tailwind and also PE expansion. But looking specifically at the annuity market, why I'm so bullish on that as a whole is recessions and uncertain economic times tend to lead to the increase in sale of annuities. You saw that more specifically in the back half of 2022 in this market, and there's no reason to think that's not going to continue into 2023, given what we've talked about before in terms of everyone's bearish or neutral or cautious. Let's just call it cautious. I don't know anyone that's really bullish. Cautious is the right word, and that's a great thing for annuities. And I'm going to point to a very specific example. consumers spent $300 billion in annuities in 2022, which is a record amount being spent on annuities. But keep in mind, with $300 billion, that's with the market down. So if it was at 2020, if at the highs of the market, that would be another 10% higher, which just gives, you have $1 million is $1 million less than it was the year before. But the previous record on when the most annuities were sold prior to last year was 2008. So think about that specifically. With the market like 3 or 4 times lower than it is today, that's when the most annuities were sold in 2008 and during the last recession. So if you extrapolate that, if you have the same amount of annuities and the same amount of pricing power, the annuity market is, in my mind, is undervalued in how much it's probably be sold in 2023. So, and there's another thing. The increased interest in annuities is because it's giving investors a peace of mind in a volatile and declining market, and like in the bear market that we've been in. And the other thing is higher rates make these annuities look much more attractive at a risk reward and offer yield that investors haven't seen in a while. For years there was no yield, so therefore these annuities didn't look like there was any. They just didn't look attractive. There's the old sayings like there is no alternative. That's why equities for 10 years just kept rallying, because the yields looked terrible elsewhere. With some of these annuity products, you can look at some guarantees like 5% yield plus some upside to the equity market. So that's obviously a great selling point to FAs. Furthermore, the demographics are now helping annuities. As the average annuity buyer is 60 years old. Most of these, once you get to 60 years old, most of the people are entering retirement and getting close to retirement, looking to protect their wealth, especially with recency bias, where last year the market wasn't great. And it makes sense for retirees to put some portion of their money into something with some kind of protection. And if you look at the demographics of baby boomers, there's about 10,000 of them retiring every day. So that's, if you look at numbers, there'll be 75 million baby boomers that expect to retire by 2030. So that's another large market of buyers that are seeing, some turmoil, that want some protection, and these products just look better than they ever have. So, as you know, like if you're a retiree, your greatest fear is running out of money when you're old. So some of these products, some of these annuity products have guaranteed lifetime income then they make sure that they guarantee them money if they live till 70 or 120. So, this whole current environment of the looming recession in people's minds in the media, whether it happens or not, plus a bunch of retirees, it's create like almost a perfect storm of why the annuity market should grow in the next couple years. And as the leading and best run annuity company, Jackson clearly should benefit. So looking a little closer at the valuations, it's ridiculous, as I've said, but I think it's because people just don't understand the company. If you look at Jackson compared to other life insurance companies, the average life insurance company trades around a 9.5 PE. So this is more than 4 times lower than that. And the S&P, like I said, is trading around 17.5 times. So even if they got to half of the insurance company's PE, this company should scream higher. I think a part of why it's been underfollowed and misunderstood by investors and fund managers because it's boring. Another reason was I think it was spun off in 2021 from Prudential. And I think a lot of times when investors get spinoffs and they show up in their accounts, they don't take the time to understand the business. They just sell it because maybe the thought is, well, if this company that I wanted to invest in wanted to get rid of it, well, then why do I want to own it? So I think that's another reason why it's underloved. It's got a medium grade credit rating, but again, I think that's wrong. I think that's partly because it's new and misunderstood. like if you look at these financials specifically, the company's got $5.3 billion in cash and equivalents and $4.6 billion in debt. So giving them net zero debt. So the company's clearly not over leveraged. The balance sheet has $303 billion in total assets and $293 in total liabilities. So a total net equity of about $10 billion for a $3 billion market cap again. If you look at how they hedge their exposure, they netted $8 billion of gains in 2020. So again, they know how to handle this market. And their cash flow is consistently positive. Over the last 12 months, they've generated over $5 billion for operating cash flow. And so, again, I can bore you with all the financial ratios, but the company just paying over 6% dividend, and they're just paying out 12% of their dividend, or their dividend payout ratio is 12%. So again, it's got strong dividend safety. Again, so they could pay a higher dividend, but why? What's the need to? They're, instead of paying out dividends, they're also buying back stock. So again, all these things are they have excellent financial ratios, and again, this is a name that really should scream higher. Bottom line, if the company's expected to increase earnings 17% year over year, and at this PE, it's clearly a stock in my mind that could go much, much higher. They've got so many tailwinds and they got great financials. And if in my mind, if the stock could even triple if rates stay steady around here and the market stays in this plus or minus 10% range, which I think is feasible. Like I said, there's a bull market everywhere, and I think this is an area under the radar, and even within the financial sector, that has real upside here. So in terms of structure, I like to keep it simple here because I think, like I said, I think there may be a lot of upside here. I'm looking out to June. June gets two earnings reports. The June 35 calls are trading around $5. The June 40 calls are trading around $3. Keep in mind, when you buy calls, you don't get the dividend. So if that's a consideration, maybe you can consider outright stock instead. But in terms of leverage, buying either one of those gets you tremendous leverage. If the stock goes to 60, the June 35s, you'll make over a 4-to-1 risk reward, and the June 40s, you make over a 6-to-1 risk reward. So, like I said, again, there's a lot to like here, and boring is good in this case.
Absolutely. That's a really interesting idea, and with loads of industry tailwinds as well, as you went through the demographics, rates, the economic uncertainty going forward as well. Jason, let's go back to you. You mentioned you had a couple of other ideas you wanted to discuss.
Yeah. I have to say, Jackson Financial sounds like the kind of boring that we like. Right. So yeah, the other two things that I've actually bought in the last week are something called the FXI, which is a China large cap ETF, which I'll come to in a moment. And also, I've actually been buying some WTI, so West Texas crude oil. Now, I think everybody has probably heard about the the China reopening situation. But just to go through it briefly, so I did something that I really hate doing, actually. So I basically held my nose and I bought an asset which I think already looks overbought from a momentum perspective. But bearing in mind, we're talking about portfolios here. So, it's just one position. But I happen to think that I had to kind of hold my nose and buy this because I just wanted exposure to the idea. So I bought it at $31. It's not 51, at $31. So this is FXI. It's a China large cap ETF. It holds things like, all the ones that Alibaba, Tencent, JD.com, the large Chinese banks, etc., Baidu. So why have I done that? Why have I bought something which I think is overbought? Right. Well, China, obviously, they've very abruptly decided to drop the ultra strict rules that they had on, almost every single activity. And I think that, this has got a decent global impact. So it's not just domestically where it's going to have an effect, a big effect, but also, I think outside of China, this has implications for tourism, for consumption, also, for some of the supply chain crunches that we saw in the last year and or so. Yeah, there are going to be some road bumps along the way. We'll talk a little bit about the bear case or the contrary case in a moment. And, it'll probably take, quite a long time for the full adjustment to the process to take place. But long story short, I'm of the opinion that it's now that he's done it, or the Communist Party have done it, I think it's very hard to reverse. So in terms of the tailwinds, already last week, we've got the Chinese central bank, the PBOC, saying that they're going to step up financing support in order to spur domestic consumption and key investment projects, and crucially to support the real estate market. They've also, as a country, they've partially eased their kind of unofficial ban on Australian coal imports. In other words, they are open for business. Now, this exit from zero COVID-19 was originally expected to sort of come in phases. Instead, it came all at once. So we've got even more support for the flailing property sector that's going to be coming soon. They're relaxing enforcement of the 3 red lines policy that essentially kicked off the sort of acute phase of the property crisis. Even if you don't want to play China, which is understandable, some people still think it's uninvestable. But as I say, this is one position for me. I still think that, the effect of them reopening does have, implications for global demand, which also filters into the kind of oil idea. So a successful reopening, it depends on your interpretation and on the timing, but we could view it in terms of like a demand dump into an inflationary global economy, or we could see it as propping up growth as we see growth going in the opposite direction in other places. Either way, there are some important implications here. To give you an idea of, how big this could be, according to JP Morgan, Chinese consumers, because obviously they've been locked up for a couple of years, they've now got a vast store of savings. And according to JP Morgan, it's about $830 billion, or just short of 5% of China's nominal GDP, which is essentially a big reservoir of pent-up demand once reopening fully happens. So clearly, domestic-facing Chinese corporations would gain from that. If you're a bull, you're going to argue that the first wave of COVID cases, which of course has been triggered, may already be past its peak. So, this kind of spending splurge may not be far off. Without official data, it's difficult to tell. These guys called GavCal Dragonomics. GavCal is quite a sort of well-respected economic strategy research house. They did an informal poll via their entity called GavCal Dragonomics. Very small sample size, I must add, but they found that 80% of the people that they polled across China had already caught COVID. 80. In any case, I think that markets might look past the actual trajectory of the virus, as long as it doesn't completely derail the reopening. And I think that if we continue at the same pace as we've seen already, we could see Chinese demand really, really rocketing. And of course, as savings get spent, consumption is going to rise. With the state support to the property sector, you could see a fairly powerful turnaround, and there's ample room for a reversal in retail sales. Now, on the kind of valuation front, the MSCI China index is currently at about 11 times forward earnings, which is still 10% below the long run average. But don't forget, if this really happens and continues to happen in terms of the opening, you're going to see upward earnings revisions and potentially multiple expansion as well, which of course will give more fuel to the potential outperformance. Chinese equity performance used to kind of perform in lockstep with the rest of the emerging market universe. Since the beginning of 2021, Chinese equities have lagged the rest of the emerging market complex by about 30%. Now, the bear case, of course, is that reopening is an extremely difficult thing to do, very hard to predict. You might get a second, even bigger wave of Omicron. Does a politically intolerable death toll prompt lockdowns again? How does the healthcare system fare under those kind of circumstances? Do we get a deadlier variant? I mean, you can see, all of the bear sort of factors lining up. And that, if we get like an on-off approach that, the economy goes back into reverse. Yes, I have to acknowledge that could be the case. However, I do think that given the way that they've gone about it and where we are now, and given the timing, we're just about to experience the Chinese New Year, which is a big time of celebration and internal travel for these guys. I'm basically going for the former case, which is obviously, the reopening to continue and to really kind of increase in pace. Now, it slightly feeds into my WTI long, and this is a very brief case that I can summarize. So I've basically been picking up WTI below $75. Why? 3 reasons. One, the White House basically told us back in October that they're buyers to replenish the strategic petroleum reserve when prices are at or below the 67 to 72 range. Take the middle of that, it's $70. I think we're kind of underpinned at 70. Second reason, well, I think China reopening kind of fits in with this story. And then lastly, the third reason for me picking up some oil below 75 is that if you look at the Commitment of Traders report, money managers are net short WTI. So these are the, in inverted commas, speculators. They were net short of WTI as of mid-December. It was the largest net short since November 2020. It's not quite as large now, but it's still a fairly hefty net short position. So again, if we kind of like think about a pain trade idea, then that would feed into my narrative.
Cool. Brilliant stuff, guys. I think we'll wrap up the episode there. It's been great to catch up as always. I appreciate you guys coming on the show, taking the time out of your schedules to do so, and sharing those ideas. Now, I'm sure all of you watching enjoyed that one as much as I did. There is one thing that I want to mention to you guys just before we close the show, which is that we've got a webinar coming up on the 21st of January. That one's hosted by Anton Creel and Raj Malhotra here, and it's titled How to Get Ridiculously Good Trading Stats. Now, that one's for first-timers only, meaning you guys that haven't purchased any education through ITPM before, but it will be a really useful webinar to kind of attend as we go into the new year to kind of kickstart your trading this year. If you want to sign up for that one, then go to our website, itpm.com. Likewise, if you want to look at anything else that we've got on offer, it's all on the website. We've got courses, we've got mentoring programs, we've got more webinars coming up. So just keep an eye on things up there. But that is it for today's episode. I hope you guys all enjoyed the show, and we'll see you next time for another episode of What's on Your Mind.